What does a strong implied volatility mean when we have earnings coming up on some really big stocks in the next few weeks? Let's take a look today at stocks like Apple, stocks like Google, and stocks like Roku and see what can earnings do on stocks like this in today's market brief. All right, everybody, welcome to today's market brief. Hope you guys are having an absolutely amazing morning. I'm your host, Chuck Fulkerson of TradersArmy.com and Mainstage Capital Group. By the way, speaking of Traders Army, we are having a free preview week that starts on Sunday, February the 4th. So go to TradersArmy.com. Just register for a free login, and you're going to get access to our free preview work where you're going to join us for our live trade rooms and get access to all of our tools, resources, and the amazing community that we've put together. Okay, so let's talk about what we have going on this week. And this week is a big week. It's earnings week here in the markets. It's the one that I really talk about as really the one that people kind of center themselves around. And we've got stocks like Apple and Microsoft and Google as really the big names that are announcing earnings this week. But what does a strong implied movement look like in an equity around earnings? So today I want to break down a couple of stocks and take a look at what they could do around earnings and what some trades may look like, and then one that's given us a pretty big implied overall movement. So let's go ahead and dive into the charts. So the first one that I have here that we're going to take a look at is Roku. Now, the reason I have Roku identified here, and by the way, this was a really nice retest to a very strong area of demand, but our inability after this demand level has been touched, the inability to create a new high. The inability to create a new high tells me that this level is probably not going to be another level of demand. And so, with that not being another level of demand, I'm more than likely going to want to remove that area as a demand and start to really look towards a lower level as an area where I would look for demand. And when I look below, when we look below this area here, which was just tested, the next area is not until all the way down here at about $57 a share, right? And that's really far away. That's a long way for price to fall. Now, earnings are on Valentine's Day, February the 14th, after the market closes. And so, while yesterday we closed on the high, one of the things that I like to take a look at is the average volume. And when I look at the average volume, um, so I gotta have it. There it is, right there. When I look at the average volume of this stock, and I did not mean to delete, load study set. There we go. Yesterday, slightly above volume than the prior 2 days, but still below average volume overall. And so what we're seeing is very, very small candlesticks in the last few days. But coupled with small candlesticks are options prices that are indicative of a strong movement. Now, we've got options that go out February 2nd, February 9th, as well as February the 16th. And one of the things that I take a look at is to see how far away, and when we're looking at our fund and identifying opportunities in that market, we say, how far away can we sell options and still receive premium? Well, as I look at that February option, I'm at $93 is the current price. The number that I typically start to look at is 1% because 1% is a really good number to look at for a monthly rate of return. And when it's only taking up 10% of the underlying strike, that becomes 10% return on capital. And so when I come down and I look, and I really start to find where's my 1% option, well, I can go and get 1% all the way down until about $72 a share. Basically, the market is telling me that they're willing to pay me up to 1% for the next $21 of Roku price movement. That's a big, big, big buffer, if you will, that they're giving me on the put side. Well, what about on the call side? Well, if I go to the call side, I do the exact same thing. I can get 1% all the way out to $125 a share. And that means, not quite 125, excuse me, $120 a share. And that means that the market is basically saying, listen, we're going to give you about $20 one way or the other that we think this thing can move on an earnings report on a $93 stock. Well, when I sit back and I look at that and I just simply say, well, what is $20 divided by the current $93 cost base? It's the market saying we're going to give you a 1% rate of return at 21.5%. Now that's all the way out to February the 16th. So they're going to give me 1% rate of return for a 21% movement in that stock. That to me tells me that the market thinks that this thing could move violently on earnings, right? It's being priced that it can move violently on earnings. So let's look at the implied volatility. And so when I look at the implied volatility, and this is our Traders Army implied volatility range indicator, we see that our volatility is really, really high. This is kind of what happens to Roku on earnings. On earnings, we see that volatility gets fairly high, and then we get a big sell-off. Volatility gets fairly high, and then we get a big drop-off. Now, we are not quite near our highest third of volatility, highest fifth, of volatility, but we are definitely in the highest range of volatility for this particular position. And so one of the things that I would look to do is to say, if I'm looking to get into this, the temptation is to buy something that says, all right, well, I'll make money as long as Roku goes outside of this range. And the temptation is to buy either what's called a straddle or a strangle. And when I buy a straddle or a strangle, if I go out and take care of one of these, let's say that I buy the 93 put and I buy the 93 call. In that case, it says, well, I get to make money either way, whether it goes up or down. If the market goes up, we make a bit of a profit. If the market goes down, we make a bit of a profit. And that sounds great. In reality, the downside of this is that if I look at this on expiration, which is the, we have to hold it till the 15th. If the stock goes nowhere, it's $1,000 a risk. And in order for the stock to be just at break even, we have to drop to below 77 or above 108. So essentially the market is saying we think that this stock has a really good chance of being somewhere in this range. Now, when I look at that, the market is basically saying we think your break even is 77 and 108. Well, if your break even is 77 and 108, let me change this color here to make it a little bit easier to see. This is where we lose money. The market is slightly pricing in. I've got a 14% up move here from current price and a 17% down move. So market would have to move 17% to make money on the downside, only 14% on the way upside. So the market is essentially pricing in a big movement, right? It's pricing in a big movement one way or the other. You're being paid paid a little bit of a premium to sell options outside of this range, and you don't get paid if it stays inside of this range. So that tells me whether I'm going long or whether I'm going short options. Now, if all of this is Greek to you and some of these options conversations are above what your current options knowledge is, go to Traders Army. We've got free options classes on the website. You can learn a lot more about options. But so how am I playing this on earnings? I'll give you the great answer. I'm not. This to me is don't touch it with a 10-foot pole. That's what this stock is telling me. And so I thought I would start with that one as kind of a cautionary tale. Let's move over and take a look at Apple. And when we take a look at Apple, Apple has earnings being reported on 2/1. So very, very soon, Apple's having earnings being reported. And in my mind, there's two areas for Apple. One would be a breakout above this $200 price point. Now, that $200 price point is a psychological line of resistance. It's an all-time high. And so a break above that psychological line of resistance would mean that there's a good chance for price to continue to run. Or there's a pullback into this 170 region. This 170 region is an excellent area of demand. And when I look at that on, say, a weekly chart, that would actually be an area that we've tested before in the past. Now, If on earnings we gap below that 170 region, well, in my mind, then that would have set up an actual double top. And so the measured movement on a double top, if we take it and extend it down, would put us somewhere back into these lows of last year. I don't know that Apple's going to get that low, and if it does, I think we're going to see the entire Nasdaq take a really big hit because Apple certainly our largest market cap stock in the Nasdaq. And so my gut says that we're probably going to trade a bit higher on earnings, just simply based on the fact that our money flow continues to be strong. Money does continue to flow into Apple. I've got higher swing highs, same swing lows, and we did a video about this just last week, right? When we're in a position where it looks like a double top and it can go one way or the other. Typically, we're going to want to go with the trend direction. So my prediction for Apple is that we are more likely to see price rally up on earnings than we are to see a strong pullback. It's not quite as strong as what just happened with Netflix, which was a very strong gap and go situation. But if we do break above, then take a look for that gap and go as a way to approach that Apple position. Last and certainly not least is Microsoft. I'm going to talk about Microsoft for a minute because Microsoft is sitting at an all-time high. We've got a lot of strong levels down here below us, and Microsoft has earnings today. Microsoft is announcing earnings. And so how might I play Microsoft? Well, I will tell you, in a perfect world, I would see Microsoft pull back actually a little bit to about 386, where I've got a strong area for a buying opportunity. This will be a little bit of telling us what's going to happen in Nasdaq in the Nasdaq as well as in Apple. Microsoft very, very heavy into the AI, a lot of enterprise sales of their AI system. Many companies starting to really lean into AI, and when leaning into AI, what name is more trusted in the software industry for organizations and corporations than Microsoft? And so Microsoft is taking advantage of that. And so I think we can see a really healthy earnings report coming out of Microsoft. I wouldn't be surprised to see Microsoft take a look at a reverse split here coming soon as that price is continuing to reach up. So I am bullish in both my outlook on Microsoft and Apple around their earnings reports. And both of them, I'd love to see a bit of a pullback for a chance to get in. Apple is much better for the breakout setup. Microsoft is actually better for a bit of a pullback in its overextended rally that we have so far today. But what do you think? Please, I'd love to hear it in the comments below and let me know what you think. Once again, go to TradersArmy.com, get a free membership. Join us starting Sunday, February the 4th for our free preview week. I look forward to seeing you there. I will talk to you soon. See ya.